Chapter 15 is long-term liabilities. Now, briefly, we can go back and see what the liability is. And the liability, again, has all the three components of time in it. It has past, it has present, and it has future. So what the liability is, the pure definition for the liability is current obligation or something that we have done in the past, which has to be settled in the future. Now, the current liability is everything within 1 year. If we have to pay for our obligation, if today I have to pay for something that I did in the past within 1 year, that's make it current. What's the long term? Long term is any liability which is not current is long term. That's pure definition from the accounting standards. Any liability which is not current is a long term. And for the current liability, we're looking for either to be within the operating cycle of the company, either 1 year, whichever is longer. No, whatever is shorter, whatever is longer. So let's move back to the long-term liability and start digging with the long-term liability to see what kind of thing is that. Again, long-term liability, any liability which is not short-term is a long-term, or not current is a long-term. Bond is one form of long-term liability. Now, what is bond? Bond is agreement, formal agreement, not informal, formal. That means they has to be formed. And usually it's a signed contract between two people. One is the borrower or the issue of the bond, and the other one is the bondholder, who is the lender. If I lend you money and you take my money, you have to issue me a bond and I'm start holding the bond. Which bond is your bond? But because you owe me money, for the time being, I'm gonna hold the bond. On the bond's gonna say how much you borrowed, on what day you're gonna pay me back, how much interest you have to pay me, on what date, and on what date. That's pretty much what's gonna say on the bond. Bond payables is the one, obviously, if you have a bond payable, that means you issue bond. That means you borrow money for the long period of time. Now, the bond payables, those are group of notes payable, which issue to the multiple lenders. So you don't have to issue bonds only to one person. You can issue bonds for many persons, which makes them bond holders. If somebody holds the bond, that means somebody is going to pay him. What he's going to pay him? He's going to pay him a fixed amount in the future date plus interest on through the period until the fixed amount is paid. Which is the fundamentals again on the bonds? On bond, we're going to have a principal amount, principal value, which is called also maturity or par or face value. So be careful with the questions when you're doing the questions, because you can see that the principal value as a maturity value or par value or face value, it's all the same. And the different question, you may see the different terms used. And one question can say, the par value of the bond is $1 million. The next question you can see, the face value of the bond is $1 million. And you start wondering, okay, what's the par value is the principal value, what's the face value? Same, principal value. Or you can see maturity value of the bond is $1 million, same, principal value. Those are used interchangeably and can use in different questions in either of those terms. Maturity date. Maturity date is pretty much on what date the bond matures, means expires, means whoever borrowed the money has to pay the principal back. Since it's a formal contract, that date specifically will be communicated with the borrower. The person who borrowed the money, he knows exactly on which date he has to pay the money back. What's going to happen if you don't pay back? The other person is going to put you in court. He can sue you for that. Why? Because it's a formal contract. You cannot escape from that contract. Then we're going to have a coupon rate, which is also called interest rate. Now the interest rate is the interest rate that the borrower of the money will pay to the bondholder within the time of the bonds. Now, those will be regular payments, and those regular payments can be monthly payments, it can be quarterly payments, it can be annual payments. Where we're going to see those payments and how the payments going to be, and the interest rate, we're going to see it on the contract of the bond or the bond itself. Now let's see what that kind of type of bonds we have. The first type of bond that you may see is the term bond. The term bond will be the term bonds will be different. Let's say I issue different bonds, but all mature or all expired on the same date at the same time. Serial bonds is the next type of bonds, will be the bonds that mature in installments at regular intervals. What that means is in the first year, some of the bonds expire, you have to pay the principal. The second year, some of the bonds expire, you have to pay the principal until the entire bonds expire. So basically, if you borrow $500,000 on the 5-year serial bonds, and which mature $100,000 annual, that means every year at the end of the year you have to pay $100,000. So the second year you have to pay another $100,000. The remaining balance is going to be $300,000. And then how this is going to affect you? That's going to affect you because of the interest that you have to pay, because the balance of the principal is going to start getting lower and lower and lower. So the interest amount is going to start getting lower. Next one is going to have a secured bonds, means bonds that have okay, so let's say you need money. With the bonds, when you issue the bonds, we're talking about a lot of money, usually $500,000 or 2 million or 10 million, something like that. You're not issuing the bonds for less than $500,000. Even though right now with the $500,000, you can barely buy anything. But yeah, the amount is more than 500,000 when you issue the bonds. So imagine this: you need the money. You need, let's say, $1 million, and you're coming to somebody and say, "Can I borrow $1 million?" And they're gonna ask you, "Okay, what do I get?" And you say, "I can issue bonds." Okay. On the bonds, I need the $1 million, which I'm going to pay you back in 10 years. After 10 years, I'm going to pay you $1 million back. In the meantime, every year, I'm going to pay you 5% interest. Okay. So that sounds good, because interest right now is 2.75. So that means I'm going to get pretty much double the interest. What is it right now? 5%. Okay, good. But I need collateral. I can give you $1 million. I'm happy with the terms. After 10 years, I'm happy, get the $1 million back. And in the meantime, you're paying the interest 10%, which is more than the inflation 2.4% right now. And I'm still gonna make some money. Okay, fine, but I need collateral. What means that? That collateral means something valuable, which is at least cover the value of the bond. So something that is worth at least $1 million. Usually collateral worth more than the amount of the money that you borrow. So you set up with some collateral and then you agree, okay, then that become a secure bond. What that means that if the bond issuer default means that he say, I cannot pay you the money back, you have some security and you can sell the collateral and cover the damages. You can have the other type of bonds is debentures, which are unsecured bonds, which are only backed by the good faith of the issuer. Compared to the secure bonds, debenture are more riskier. And bearer bonds, the bearer bonds, bonds is payable to the person that has possession of the bonds. They're also called unregistered bonds. So usually when the bond issuer issue the bond, he specify who is the one who hold the bonds. So basically, whoever is on the bond, he's going to get the principal and in the interest during the period of the bond. The bearer bond, we're not going to have that one. So basically, the bearer bond, obviously, you can change it from one person to another person. It can be sold on the secondary market. And in that case, the person who gets the interest and the principal at the end can change during the time of the life of the bond. Now let's say it determine the bond price and how we're going to account for the bonds. Now, before we start doing this, I think we have to talk about the time value of the money, but let's go a little bit more of the bonds and let's see how this goes. First one is the market price of the bonds. Now, as you can see on the bonds, who will be willing to invest in bonds? In other terms, who will be willing to lend you money? Somebody who's looking for return. What's the return that you can get on the bonds? If I'm holding the bonds, I can get interest. So if I borrow $1 million, I'm going to get $1 million back. That's not a problem. Not out of question. What else I can get? I can get interest. So you have two streams of cash. One is coming at the end of the life of the bond, the principal amount or initial amount that you lend, and the other one is the regular interest payments over the life of the bond. Now, the two interest rates that we have to check when we dealing with the bonds. One is the stated or the contract rate. Again, those terms can be used interchangeably. So you have to know what the stated in the contract rate is. The stated and the contract rate is actually those are the same. So this rate determines how much interest will be paid. So this determines the interest payments. And after that, we're going to have a market or effective rate, which is the rate that the investor wants for the lending the money. So there are different scenarios here. First scenario is bond can be sold at the market price. That means if the bond pays, let's say, 10% interest, and the market also paid 10%, it's going to be sold on the market. Now, there are three categories for this scenario. First one is we can sell the bond at maturity or the par value or the face value or the principal value. So if you have a bond for 1,000, we can issue the bond for 1,000 and we can get directly $1,000. Second scenario is, again, we have a bond which is gonna pay the bondholder $1,000. But initially, we issue the bond with a discount. What that means is initially we're gonna get less money, $980, and at the end of the day, at the life of the bond, we're gonna pay 1,000. So basically, we issue the bonds with a discount. And the other option is to issue the bonds with the premium, means that if I have to pay $1,000 after 5 years, today I can issue the bond for $1,015, $15 more than I have to pay in 5 years. So again, choose 3 scenarios. First scenario is today you're issuing the bond for 1,000, which you have to pay after 5 years, and somebody give you cash. Scenario 1, first the person give you exactly the cash that she's gonna get after 5 years back from now. Second option, you're gonna pay him $1,000 after 5 years, but today he's gonna give you only $980, or you issue the bond with the discount. Third option is you pay after 5 years $1,000, but today he's gonna give you $1,015. That means he's gonna give you $15 premium. When this scenario is gonna happen, and what's gonna trigger somebody to give you more than what he's gonna get, or you to be willing to get less than what you have to pay? Those are the interesting questions. So imagine this. I literally want you to imagine this. I need money. I need $1 million. I'm offering bonds. So if you give me $1 million today, I can pay you those $1 million after 10 years. And I'm gonna pay you 9% interest on those $1 million every single year. The question is, would you give me $1 million now?
No.
Why not? Pretend that you have $1 million. I need $1 million. I'm gonna give you the bond and I'm gonna pay you 9% interest every year. Would you give me that or not? The answer relies on how much return you can generate on the market today. So for example, if you can generate 9% on the market, which I'm paying you interest, then you are indifferent where you're gonna invest. Are you gonna invest in the market or you're gonna give it to me? It doesn't really matter because in both places you're gonna get 9%. For that reason, if I'm asking for $1 million, you're gonna give me exactly $1 million. Second scenario is this. I'm giving you $1 million. I'm asking you $1 million and I'm paying you 9%. But everywhere on the market, you can get 15% interest. Would you lend me $1 million? Or you're gonna invest it on the market? What you gonna prefer now? Again, market give you 15, not 10. So basically here, I'm changing the scenario. I'm giving you 9%. Sorry, let me try to type here. I'm giving you 9%. What? Let's try again. I'm giving you 9%, the market give you 15%. Would you lend me $1 million or not? Or you prefer to invest in the market? What do you prefer?
Market.
Make sense? Do you
Yes.
understand this logic?
Yes.
If I'm giving you 9% and the market gives you 15%, obviously you're going to invest on the market. Now, how can I attract you to give me the million? Because I need this money. How can I track you? This attraction things using every person. Imagine this, I'm on the business of selling groceries. Oh no, let's say bakery. I'm in bakery, I'm running my own bakery. And what's gonna happen if I don't sell my bread, but the breads that I make today, if I don't sell them today? Can I sell them tomorrow?
Yes, Professor, with discount.
With discount. Why with the discount? Why do you have to give the people discount?
Because the bread is not fresh.
Exactly. So because they not gonna enjoy the fresh bread. So basically, the same thing applies here. The same logic applies here. Everywhere on the market you can get 15%, but I need the money. And I'm gonna pay you only 9%. So basically you're losing 6%. Make sense? Over the 5 years, because I'm asking for $1 million over 5 years, you're gonna lose 6% interest. Make sense?
Yes.
So now what I have to do is I have to make you indifferent. Means I'm not gonna ask you for $1 million. I'm gonna give you discount. And I'm gonna say, if today you give me 900,000, right? Only 900,000. Now, after 5 years, I'm gonna give you 1 million. And every year I'm gonna pay you 9% interest. Now, would you invest?
Yes, Professor.
Make sense?
Yes.
So what I did, I give you $100,000 discount. So basically, if I eliminate your losses over 5 years, 6% losses, then for you, it doesn't matter where you're going to invest. You actually prefer to go with me because you have to give me less money and you're going to get more money after 5 years. So this is called discount. Does that make sense?
Yes, Professor.
Now let's go to the next second scenario. Let's pretend the market is 15%. This is the market. I'm going to highlight it in red. Market of currently give you 15%. But I'm offering 20% on my bonds. So if you give me $1 million today, I'm going to pay you that $1 million after 5 years. And I'm going to pay you 20% interest. Would you invest in my bonds? Or you're going to go and invest in the market? What you going to do now? What do you prefer, my bonds or market? Again, on the market, you're going to get 15%.
You
If
are
you
Professor, the 20%.
the 20%, you're naturally looking for 20%. But I already know that I'm going to give you 5% more than the market. You're getting 5% more than the market. I already know that. So in that case, I'm going to say, you know what? Since I'm giving you more than the market, and I'm going to pay you 1 million after 5 years, I want you today to give me 1 million and let's say 1,050,000. So the 50,000 will compensate me for the 5% more that I'm giving you over the market for the next 5 years. Now, would you invest in me? Or are you going to go with the market? Are you still investing with me or are you going to the market?
Professor, if in the market I'll pay 1 million, only 1 million, right?
Right.
And you one. So for me, I invest in market because I only pay 1 million, because for you 1,050,000, right?
Right. You have to give me today 1,050,000 and you're going to get 1 million after 5 years. But I'm going to pay you 20%. On the market, you're going to get 15%. So what you have to do is you have to calculate how much you're going to get over 5 years. Make sense? As interest. And if the interest that you're getting is more than $50,000, then you can invest. You can give me the money. Because it's still, you're going to get more. Because if you give me $1,050,000, but you're going to get over the 5 years more than $50,000 interest, then it makes sense. Do you understand the logic? Or I lost you here? Are you guys with me?
Yes, Professor.
Do you understand the logic? Another question. So watch this. You're going to the market. You have enough money. The money is not your problem. You have enough money. You're going on the market, and there's an Apple computer, Apple laptop, and there's a HP laptop. Again, the money is not that object. You know the Apple naturally is more expensive than the HP. Which one you gonna buy?
Apple,
Why?
because it's famous.
Only that reason?
The market value of Apple doesn't go down
Okay, that's a good
that
reason then,
much of that. Yeah.
right? So you're willing to pay more, naturally. Well, there's no difference between Apple and the bonds here. As long as you're getting more value than what you're paying today, you're willing to pay that price, even though it's $50,000 more. But if you get with the 20% interest, which is 5% over per year, if you get enough to cover this $50,000, you're gonna go for it. Make sense? Then it makes sense to you to pay the premium of $50,000. Another example for the girls, since most of the people here are on the girl side, question for you: what do you prefer? Again, imagine you have a boyfriend, and he asks you what kind of bag you want, and he give you options: Louis Vuitton or Chanel. What you gonna answer? Are you guys with me?
Yes, Prof.
Again, your boyfriend asks you a question, or your significant one asks you a question. I'm willing to buy your bag. What do you want, Louis Vuitton or Chanel? Which one you prefer?
LV.
Louis Vuitton.
Yes, Professor.
Really? Do you know
Or
how
it
much is the
depends.
do you know how much is the how much is the cost, the biggest bag, the large, what was that? The large bag, the regular, the standard bag for Louis Vuitton. Do you know how much is it? Less than $5,000. Do you know how much cost the small bag, the classic one, for Chanel? $7,000. So which has more value?
Chanel.
Then what we're talking about here? Come on, people. Are you seriously going to choose Louis Vuitton?
Okay, I'll choose Chanel.
Chanel.
You know what? I'm even surprised that
Because, Professor, I don't have Chanel, only Louis Vuitton. That's why.
well, you should check Chanel. Do you know
Yes.
what? Do you know what's the interesting thing with Chanel? I mean, Louis Vuitton is the same thing, right? But Chanel, if you get the bag last year, right now you're already making $1,000.
Okay, got it, Professor. Thank you. You give me an idea. So I choose Chanel now.
Yeah. So don't get confused here. Chanel is always more preferable than Louis Vuitton. Now, if you ask me between Hermes and Louis Vuitton, I think I'm gonna go with Hermes because Hermes is more valuable than Louis Vuitton. So if you have to compare Chanel, Hermes, Louis Vuitton, the classification will be number 1 is Chanel, number 2 is Hermes, number 3 is Louis Vuitton. I mean, obviously, I didn't give you example with Coach and Louis Vuitton. Then the answer is easy. You should, girls, you should know your stuff. Please, please check the items and know which one is for which one you have to pay a premium price, and for which one you have to pay the discount. Now, the other thing is, question for you. Have you ever seen a Louis Vuitton selling with a discount?
Yes.
You did?
Yeah, I did in Winners.
In winner, no, that's not Louis Vuitton. That's most likely a second head of Louis Vuitton. It's most likely is if it's Winners, Winners are not they're not authorized to sell Louis Vuitton. Louis Vuitton you can buy only from Louis Vuitton.
Okay. Yeah, I thought I
Right.
saw like purse over there.
No, you can't. That's the last place that Louis Vuitton is gonna sell the items. Why? Because once Louis Vuitton starts selling in Winners, that means it's not Louis Vuitton.
The value will be less.
Exactly. So basically, Louis Vuitton or Chanel, you're never gonna see the discount. Why? Because they're charging a premium price already. Why? Because the value that you're getting is higher. So that's what I want you to understand. If you're giving more value than the market, you can charge a premium. But if you're giving less value than the market, you have to give a discount. If the value that you're giving is equal to the market value, there will be no discount, no premium. Whatever it is, that's what it is. So now let's transfer this to the bond prices and let's see how this is going to work. So with the bond prices means that if you have a $1,000 bond, which is quoted at 100, 100 means 100%. That means the bond is sold at exactly the same amount that has to be paid at the maturity. If the bond is quoted 101.5, 101.5 is transferred as a percentage. So 115%, not 50, 101.5% in this case. So you have to apply that thing, and you're gonna see how much you're gonna get today for what you have to pay at the maturity, which is 1,000. So when you see the bond is quoted more than 100, that means the bond is sold with premium. You're asking more than what you're gonna get. And the opposite, if you see the quoted is less than 100, that means you getting a discount. So you're gonna get less money today, and you have to pay more money tomorrow. So the 100 is the one that's gonna determine, is it at par? Par means whatever you get, that's how much you pay. Premium, if it's more than 100, you're getting more than what you have to pay. And less than 100, you're getting less than what you have to pay tomorrow. Make sense? Questions so far? I'm spending a lot of time on this, so I want you to understand this idea. Okay, let's keep going then. Present value. Before we start talking about the present value, we have to talk about a little bit of time value of the money. And the time value of the money says that, what says, dollar today worth more than dollar tomorrow or less? What do you say? If you have to do the sentence, what you're gonna say? Dollar today worth more than tomorrow or dollar today worth less than tomorrow?
Dollar today worth more than tomorrow.
Explain what that means to you.
It has greater value today since you have it already, because there are factors like inflation which will lesser the value
Okay,
in the future.
that is correct. So basically, if I have $100 today, with the $100 today, I can buy more things than with the $100 tomorrow. Correct?
Yes.
Okay, I want you to understand this now. So now, for the dollar today, since the worth more than dollar tomorrow, means that sometimes we have to define the present value. Present value of what? The present value of the money that we're gonna receive 10 years from now. Question for you. If your grandparents put in their in their will that you're gonna get a $1 million after 10 years, what's the value of those $1 million today? More than $1 million or less than $1 million? Knowing that the dollar today worth more than dollar tomorrow.
So the 10 million is that I will get it in 10 years time, right?
After 10 years, you're gonna get $1 million inheritance. How much they worth today? More than 1 million or less than 1 million?
Less.
Less.
Yes.
Everybody agree? Can everybody see this? Is this clear for everybody? Okay, that's great. Then that means the present value of those $1 million today will be less than the $1 million that we're gonna get tomorrow. That's perfect. Now the future value for the bonds, once we start calculating the future value, we have to include two things. First, we have to include the present value of the future value as a lump sum that we're gonna receive after 5 years, plus the interest that we're gonna earn during the time of the 5 years or 10 years. So the present value is usually always less than the future value, usually. So the present value, how exactly we're gonna calculate this? First, we're gonna have the amount of the future payment. We need length of the time, and we need the interest rate. So let's go with this. Assume that this company issue $100 million bonds, $6, they're paying 6% interest at par. That means the market also pay 6%, which mature in 10 years. Interest gonna be paid semi-annually on January 2nd and July 2nd. So what's gonna happen? Let me copy this one and move to the Excel spreadsheet and work on the Excel spreadsheet. So I can post that Excel spreadsheet later for you. Just give me a second to open it, do some changes. Make it bigger a little bit from this. So picture, and we have it. All right. And let me share my screen now. Here we go. So assume that this company issue 100, so the future value or FV, future value, the one that we have to pay, is $100 million. 1, 2, 3, 1, 2, 3. I'm purposely doing this so we can use this later. Then we're gonna have interest that we have to pay, interest rate on the bond. Interest rate is 6%. So how much is the payment that we have to make? The payments, interest payment, that we have to pay every year, this is annual interest, will be equal to 1 million times 6%. So every year we have to pay 6 million. Now, what's the maturity? That will be the period to maturity. And that will be interest payment, we're gonna call it PMT. Period to maturity, we're gonna call it N, number of periods, 10 years. Now, the tricky part here is that we have to pay the interest semi-annually. Payments per year, those will be 2 payments per year. So every time on January 2nd, on January 02nd, and on July 02nd, we have to pay this amount divided by 2. 3 million on January 2nd, and that will be another 3 million on July 2nd. So now, what will be the journal entry when we issue the bonds? when we issue the bonds, since in this case, I can clearly say that the market interest rate on the market is exactly the same 6%. That's why we call it at par. Since we know that, then we're going to have debit. What we're going to get? Why we issue the bonds? What we chasing? Are you people with me?
Yes, bro.
Yes.
Why we issuing the bonds? What we want?
Cash.
Cash. And how much cash we want? 100 million. So debit will be cash, credit where is gonna be?
Dividends.
No. What we issue?
Oh, bonds.
Bonds.
Bond. Bond what?
Long-term notes payable.
Payable. Bonds payable.
Bonds payable. Good. I want you to come up with the terminology so it can be easy later for you. Okay? I can easily tell you what is it, but I want you to think. So we get in cash, and because we issue the bonds, that cash we have to pay back, and we issue the bonds, that become a bonds payable. Make sense?
Yes, bro.
Okay. 3, 1, 2, 3. Did I get 100 or no? 100. So let's pretend this we issue the bonds on January 2nd. 02nd. Now July 1st comes. No, July 2nd. What do we have to do on July 2nd? I have to start paying interest, right?
Yes, Professor.
Okay, so give me debit. What will be the debit?
Interest expense.
Interest expense. How much?
6 million.
No.
Half. No.
Three.
We already got 3 million.
3 million.
6 million is for the entire year. So if I'm paying on December 31st, then it will be 6 million, but I'm paying twice. I'm paying once in July and once in January. Credit. How I'm gonna pay this interest expense? What I'm gonna give to my bondholder?
Cash.
Cash. Does he want anything but cash? No, right? He wants cash. That's it. That's why he invested. And then we're gonna happen the same thing. On January 2nd, we're gonna have exactly the same thing, right? And this is gonna start repeating. This will be equal to January 2nd, and it's gonna keep repeating. Make sense?
Yes, bro.
So what's gonna happen after 10 years? After 10 years on January 2nd. Now, 10 years later. On January 2nd, we have to pay the interest, correct?
Yes, Professor.
And we're gonna pay the interest. What else we have to pay?
The principal.
The principal. We will return
Principal.
the 10 million.
Okay.
The 100 million.
100 million. Let's pay them. Debit. Which account we gonna debit?
The
The
bonds
bonds payable.
payable.
Bonds payable. Good. With $10 million, $100 million. Sorry. bonds payable $100 million, and we're gonna credit
Cash.
cash. And the bonds are gone, correct?
Yes.
We're out of cash. We did what we did. Everything is fine. This is when the market, what was that? Interest on the market is equal to the interest that we're paying on the bonds. Only and only in this situation, we're gonna have those entries. Now let's start. Let's check the slides and continue with the slides at this point, and let's follow the slides. So we issue the bonds, we're giving the cash, we're doing the bonds payable. Then the next thing comes the interest. Interest on July 2nd, we're gonna pay the $3,000 interest, and we're gonna pay it cash. Why $3,000? Because we're paying the interest semi-annually. Interest rate in Canada, every time when you see it somewhere is communicating interest, that means annual. Now, once you see the annual, then you can move to the something else. You can move to monthly, you can move to quarterly, you can move to daily. So keep going. Once after 10 years, on January 2nd, we're gonna pay the interest first, and after that, we're gonna pay the $100,000. Why we have to pay the interest first? Because we use the bonds from July to January 2nd. We're paying the last payment for the interest first, and after that, we're closing the bonds. Now, what's gonna happen if I issue the bonds between the payment dates? As you can see here, on these bonds, we're paying interest. Where was it? We're paying interest on January 2nd and July 2nd. What if I issue the bonds on April 2nd? What's going to happen then? Now, in order we to do that, and with you to see this, I'm going to move back to the Excel spreadsheet, and I'm going to show you on the Excel spreadsheet how we're dealing with these situations. So let's get this one is for par. Then I'm going to flip this one here, and we're going to have between dates. So let's pretend that we issue the bonds now not on January 2nd, we issue the bond on April 2nd. Okay? Are you guys with me?
Yes, bro.
Sir.
Okay, so watch this. I'm issuing the bonds on April 2nd. What do I know? That these bonds are $1 million. These bonds paying interest on January 2nd and July 2nd. Since the bond is the formal document, whatever says on the bonds, that's what we have to do. The fact that I'm issuing the bonds on April 2nd doesn't change the fact that I have to pay the interest on July 2nd and January 2nd. I cannot change the dates to paying interest on the bonds. It's already set up. It's a contract. It's a fixed date. I cannot change that one. Now let's think about something. On April 2nd, so basically if we issue the bonds in January 2nd, then we're going to have February 2nd is 1 month, correct? March 2nd is 2nd month. April 2nd, 3rd month. May 2nd, 4th. June 2nd, 5. And July 2nd, 6. So this is 1, 2, 3, 4, 1, 2, 3, 4, 5, 6 months, correct? Are you guys with me?
Yes, bro.
Let's insert one shape here, which is look like what's the shape that I'm looking for? This one. This includes 6 months. And then I have another, which is starting July 2nd, August 2nd, September 2nd, October 2nd, November 2nd, December 2nd, and January 02nd. That's not land, that's Jan 02nd. So now I have another one. Another 6 months. And that give me 1 year, correct? I already know that here, for those 6 months, I have to pay 3 million. What was that? 3 million here. And here for those 6 months, I have to pay another 3 million. But the problem is, I'm not issuing the bonds on January 2nd. I'm issuing the bonds on April 2nd. On July 2nd, I have to pay $3 million because I cannot change the payments, I cannot change the date, I cannot change the conditions. But is the person holding the bonds for the entire period of to collect the interest? If I issue the bond on April 2nd, so that means the person who get the bonds, he's going to have the bonds only April 1 to 3 months, correct?
Yes, bro.
But I have to pay him interest for 6 months because that's what says on the bonds. I have to pay the interest 3% or 6% annual 2 times on July 2nd and January 2nd. I cannot change that one. So is it fair he to receive 3 million, which I have to pay, there's no questions about it, but I borrowed the money, I owe him the money only for 3 months. Is that fair? Would you pay me interest so basically on July 2nd, you have to pay me 3 million. But I give you the money on April 2nd. Is it fair for you to pay me the interest for January, February, and March? Since I give you the money on April 2nd.
Yes.
Yes, so you're gonna give me the $1.5 million for free?
Doesn't that get deducted from the principal amount or?
No, you cannot change the payment amount. On the July 2nd, you have to do cash. You have to pay cash, $3 million. I cannot change this $3 million cash. I have to pay on July 2nd $3 million. But again, I get the money on April 2nd. Is it fair for you to pay the interest for January, February, and March?
No.
No. So what we're gonna do in this case? What we're gonna do, very simple. We're gonna ask, since we cannot change this payment, we're gonna ask here the person to pay us for the interest that he's gonna receive on July 2nd, which he's not entitled to. What that means is I cannot change the cash 3 million, I have to pay cash 3 million. I'm gonna say this, you know what? For the months of January, February, March, the interest that I don't owe you, but you're gonna get in July, I want you to pay it now. And we're gonna get, in this case, what was the account exactly? Let me double check on the account name. That account is called interest payable. I have to pay that interest. And I'm gonna ask the person to pay me additional. Don't note this. Insert, I need to delete those one. I'm gonna ask him to pay me those, which I'm gonna give him on July 2nd. And I'm gonna ask him to pay me 1,500. 1,500,000. So the cash I'm going to receive is not going to be 100,000, 100 million. It's going to be 100 million plus 1.5 million. Now, on the payment date, he's going to get his 3 million. Don't worry about it. He's going to get the cash 3 million. But that cash 3 million, for me, my interest expense will be only 1.5 million. The other 1.5 million, it's going to be the money that I collected from him. I'm going to give it to him back. And I'm going to close this interest payable. Make sense? Do you understand this logic?
Yes, prof.
So for the months that we don't have the money, we're going to ask him to pay us in advance. Why? Because when he receives the interest, he's going to get the interest for the entire period. So it's more like a giving back and forth the same amount of money. So he's not losing the money. Don't get me wrong here. Nobody losing anything. We just want to make it fair. Example in reality, that's what's happening in reality. But another example that you may see is this. If you buy a property in the middle of the year, and the owner of the property already pay property taxes, once you become the owner, since you're the one who's going to take advantage of the property, those taxes are related to you. The fact that he already paid the taxes, it doesn't change the fact that now you're the new owner. So when you buy the property, you have to pay him back for the property taxes for the period on the day that you become the owner until the end of the year. So basically, you reimburse the previous owner for the taxes that he paid in advance for the period that you're living in the property. Same idea is here. I'm getting the interest for the entire 6 months, but since I didn't give you the money, I give you the money only on April 2nd, which is 3 months until the payment date. I'm going to pay you the interest for the months that already passed for the interest payment period, which I didn't give you the money. And once you pay me the 3,000, that's going to cover that money that I already pay you, plus the new interest that I'm receiving. Okay, that's with that. Let's go back to slides and see how the slide's treating this. So this company issued $200 million, 5% 6-year bonds, which are dated June 15th, which are issued July 15th. Interest is paid again semi-annually, and the bondholder are paid full semi-annual interest amount on the interest payment date, December 15th. Now, on July 15th, this company sells $100,000 bonds only. 1 month after the bonds was issued. So July 15 is 1 month. The bond is issued on June 15, but now we're selling the bonds on July 15th. That means that we still have to pay for 6 months, but we have the money, or we owe the money only for 5. So Manitoba Hydro, which issued the bonds, we're going to get the interest for the month that didn't have the money, in addition to the principal. So how that goes? The Manitoba is going to pay the interest expense, the cash, 2.5 million, 250,000, sorry, $2,500 for the 6 months. But only for 5 months borrow the money. So for the first month, whoever give you the money, he's going to pay you the interest for that month, and you're going to give him the money back when you pay for the 6 months. And again, the recording will be on the issuing date. You're going to get the $100,000 from the bonds, which you have to pay after 6 years, plus additional interest for the 1 month, for which you don't owe interest. You're going to get that money for the time being, and on the payment date, you're going to give them back to the bondholder by paying the interest for the entire 6 months. So for 1 month is going to be money giving back, and the other 5 months will be your interest expense. So now let's see the different scenarios and what's going to happen in different scenarios. We're going to go with the issuing bonds on the discount, issuing bonds on the premium, and then I'm going to let you for a break, and then we're going to move forward. In order to give you those one, let's go first with the discount. I'm not going to work with this here, this information. We're going to move to the Excel spreadsheet. And again, later on, I'm going to post you that Excel spreadsheet, so you're going to have it. Let's start with the par, information about the par, and I'm going to flip it here. And now let's go with the discount. Same scenario, company issue $100 million, and this time is not on par. Let me change that par first. Let me see how it's on the slides. But I'm going to change the interest rate on the slides just to make it more interesting. Just give me a second to change the information, and then we're gonna go with this question. Trying to find some big changes in the interest, so you can see you can feel the changes, actually. Okay, can you see my screen?
Yes, bro.
Okay, so again, we issued the bond for $100 million. We have to change everything here. Not everything, but some of it. $100 million. That's how much we have to pay after 10 years. Interest that we're going to pay on the bonds is 6%. So the annual payment, let's go here, annual, interest payment is 6 million. We're gonna pay those one. Gonna push those one back down a little bit. We're gonna pay those one 2 times a year. On January 2nd and July 2nd. So our PMT payments is 3 million, which we pay on 2 installments on July. Annual is 6 million, but we're paying that one in 2 installments or on January 2nd and July 2nd. Next thing is period to maturity. When those bonds mature, they mature in 10 years. Actually, I'm gonna flip it here a little bit space. And the last thing that we need is the market rate. How much is the current market rate? And the current market rate is, in our case, is 8%. Now, question for you. Would you be willing to invest to give me your $100 million if everywhere on the market you can get 8% and I'm paying you only 6% if I don't give you discount? Again, would you be willing to give me $100,000, $100 million, which I'm gonna pay you in 6 years? Oh, sorry, in 10 years. If everywhere in the market you can get 8% and I'm paying you only 6% without giving you a discount?
No.
No. So if the market pay more and I'm paying less, I have to give you discount. Do you understand this? So now, the question is, hello. Now the question is, what's the difference? What's the part? When is the value? What is the value that, considering the market rate, it will be equal to the value of the 100 million plus the interest over the 10 years, which is worth today. So basically what we're chasing is the present value of, first we're chasing the present value of $100 million after 10 years, which is the principal. And we're chasing the present value of the interest payments over the same period of time. Once we combine those two, we're going to get the present value of the bonds. Make sense? Now I'm going to start putting some abbreviation. Future value is future value, FV. The payments that we have to make on the bonds is PMT. Period to maturity, how many years, in terms of years, is N. Market interest rate is I/Y. So now, I have to check what is the present value of my principal plus the payments that I have to make twice a year over 10 years. Actually, that's not going to be N. With the market rate interest 8%. So now watch this. I'm gonna make a little bit adjustments here to make everything to make sense. So I have to pay interest 2 times a year. Correct? How many payments I have to make over the 10 years
20.
of interest over 10 years? I have to make 20 payments, correct? And since I'm making 2 payments per year, what will be the market rate? Let's highlight in this one with the blue, and this one will be the interest, market interest per payment. How much will be the market interest for every payment that I'm making? Is it going to be 8% or going to be less?
Less.
Less. How much will be less? How much exactly will be? It will be 8% divided by 2. Why? Because I'm paying the twice per year. Make sense?
Yes.
So now the payments, this one will become my N, number of the periods that I have to pay the interest. That will be the interest that I have to use for my calculation. Now let's start calculating the present value. For the present value, what we're going to use? We're going to use the formulas. We're going to go to financial. We're going to scroll down. And we're going to go with the one that's chasing the PV, which is present value. Can you see it? Are you guys with me?
Yes.
Once you click the PV, it's going to give you this chart, this table. Now, this table is going to start asking you questions. First question is rate. Rate is equal to return per returns. The present rate is the interest rate per period. For example, use 6 divided by 4 for quarterly payments. So if you have 4 payments per year and your interest is 6%, you have to go 6 divided by 4. In our case, market rate is 8. Since we're paying semi-annually, the percentage should be 4. So we're using the 4%. N is the total number of the payments per periods in the investment. So it's 10 years, but the total payments are twice per year. That means 20 payments. PMT. PMT is the payments made each period and cannot change over the life of the investments. So every time when we make a payment, we're paying exactly 3 million. So our PMT is 3 million. And since we're making that payment, that means that's a cash outflow for us. So we have to put a minus in front. Then we're going to the FV, which is the future value, or cash balance you want to obtain, or in this case is how much we have to pay after all the payments are done. We have to pay $100 million. And since this is outflow for us, we're going to put one minus in front. Last thing is type. Now, it's a logical value. If we have to make a payments at the beginning of the period, which is if we have to make the payments, period will be from January to July. If you have to make a payment in January 2nd, then we have to put one. But if you have to make the payment at the end of the period, we don't have to put anything. And we're making the payments not in the beginning of the period, at the end of the period on the bonds. So we can skip that one and leave it blank. And then when you press OK, it's going to give us our present value of principal of 100 million dollars and interest payments of 6 million times 10 years. So the present value of those two numbers are 160 million. Today, at effective interest rate 8% per year, is $86,409,643. And this is the amount of cash that we're going to receive on the day when you issue the bonds. So our journal entry will be cash of that amount, and credit will be bond payable. I'm trying to figure out what I can delete. That's not bond payable. And that will be credit here. And that will be our bond payable. Now, as you can see, now we have a problem. What's our problem? Debit is not equal to credit. We're getting 86 million 409 8600 409 $86,409,673. But we have to pay 100 million. So we need more debit. And that debit will represent the discount on bonds payable. And the amount will be exact amount to balance the difference. And this will be our journal entry when we issue the bonds when the market rate is higher than the bonds. Now let's see the opposite. What will be the journal entry if we issue the bonds with the premium? Sorry? Let's go
You
with the
have to
next
be
one.
there before 3. Kasi aalis na si Manong Dadong ng 3. Ibibigay ko sa kanya.
Who's going to be there? Antoinette? Antoinette, who's going to go?
Oh, sorry,
So-
Professor.
No worries. So, let's go with the next one, which is the premium. Let's see what will be the scenario that's going to trigger the premium. In order to be the premium, the market, it has to be below of what we pay. Now, let's go with this time. Market is 4%. If the market is 4%, we have to do slight adjustment somewhere, and that will be the interest rate of the market. The bonds are still 100 million. The interest that we're still paying is 6% or 6 million per year, 2 times a year. So in every payment we pay 3 million. Let me delete this formula because I want we to do the formula again. Number of years, they don't change, 10 years. So every year we have to make 2 payments, so the total payments of interest over the 10 years will be 20. Now the market rate is now 4%. Now question for you. If the market is below of what we're paying on interest, what we should expect, discount or premium?
Discount.
Again, if the interest rate on the market is higher than what we're paying, I have to give the people discount. Otherwise, they're not going to invest in me because my bonds are not attractive. Now, the other opposite scenario is market is 4%. I give them more value than the market. Do I have to give them discount or they have to give me a premium?
Premium.
Premium. Now I can charge them more because I'm give them more value than the market. Make sense? So let's see how much more we can get. Again, we're gonna pay them $100,000 after 10 years. Over the 10 years, we're gonna pay them 3 million twice a year. So let's see what's the present value of this. So here, in order to calculate the present value, again, we're gonna go to formulas, financial, scroll down to get the present value, PV. Once we get to the PV, we're gonna start asking the questions. Rate. Rate is the rate of each payment that we're making, which is 2%. N is the number of the periods over the life of the bonds times the payments that we're making per year, which is 20. Payment is the single payment that we're making on the date of the payment, which is 3 million. And since this is the payment for us, it has to be negative. Future value is the amount that we have to pay after 10 years, which is outflow for us, also negative. And type is, we don't have to type anything here because again, it's at the end of the period. And once we click OK, we're gonna see that in order to pay $100 million after 10 years with interest every year of 6 million, people have to give us today $116,351,433. Now, as you can see in this case, we have a difference on the credit side. And that difference will be our premium on bonds payable. And that's premium, or it's going to be equal to this amount minus that amount. And that's how we're going to issue, well, that will be journal entry when we issue the bonds with the premium. Again, we're going to get more cash than what we have to pay, and everything else will be premium. Where in the discount, we're getting less cash than what we have to pay, and the difference is related to discount. Let's have a break now, and I'm going to catch you with the slides in 10 minutes. How is it so far? Do you understand the idea with the bonds?
Good, Professor.
Okay, great. Take a rest a little bit and we're gonna continue.
Oh, Prof, I have a question.
Yes,
For the quizzes, are we gonna do it in class or is it on our time until the day ends?
in your time.
But today's
Oh.
the deadline, right?
Let me double check on that one. It's actually tomorrow. The due date is tomorrow.
Thank you, Prof.
Okay, guys, ready?
Yes, Prof.
Yes,
Okay, let's
Prof.
go. Let's
Yes.
go then. Let's go. Let's go to slides now. Let's go and see the slides, how the slides going. So for the slides, there's a slightly different. I know I changed this one here. So for the slides, they're using different percentage. They're using again with issue $1 million, 6%, 10 years bonds, 98% face value on January 2nd. Market interest rate is 6.27. So in order we to get the numbers that they're getting, what we have to do is I'm going to copy this information. I'm going to move to Excel spreadsheet that we have. Let me share that Excel spreadsheet. And we're going to do it the same thing with the same information that they have. So you can have exactly the same situation. So you can compare then what we have with the slides. So those are 1 million, 6%, 10 years, 98% face value on January 2nd. So market rate is 6.27. So the future value here is $1 million. We have to change that one. 1, 2, 3. Interest rate is 6%. We're not going to change it. Annual interest rate, we're going to pay. It doesn't say how many times we have to pay this interest rate. Let me check the slides to see what they say on the payments. Yes, 2 times. So there's no changes in the interest payments. Interest payments again, July, January 2nd and July 2nd. Now the periods are 10 years. The 10 years are but the periods are 20 times we have to pay that interest. Now the market rate here is 6.27. Before I do this, I want to delete this number. So market rate is 6.27. Or per payment, per single payment, the interest rate is 3.14. So now let's calculate the present value. I purposely delete that one so we can go and do the calculation ourselves. Again, we're going to use the formulas. We're going to go use the financial. We're going to go the present value, which is PV. Present value is going to start ask us for the information. The rate, we're going to use the interest rate per payment, per single payment, not for the annual, for the single payment, which is 3.135. In this case, the number of the payments over the life of the bonds that we have to pay the interest is 20. Payments, every single payment we have to make, we have to pay $30,000, which in this case is negative for us, it's outflow. Future value is $1 million, which we have to pay after 10 years, which is again outflow. Now the question is, what's the present value? And the present value we're coming with, it's going to be $980,163.82. So basically, we're going to give a discount of 19,836, which will be the difference and the interest between what we're paying on the bonds and what the market pays. The journal entry will be, the present value will become the cash that we're going to get. The bonds payable, they're not going to change. It's always going to be $1 million, or the amount that we have to pay after 10 years. And the discount will be the difference between those two amounts. And that's how we're getting this amount. Now let's go and check is what we get is what stays on the slides. And the slides are right here. So as you can see, the slides getting 163.82, which is exactly what we're getting. They're rounding up on $980,000, and they give us a discount of 20,000. So if we want to be correct in our calculation here on the Excel, what we're gonna do is we're gonna change this amount to 980, 1, 2, 3, and then we're gonna have exactly match between what we're getting here and what's on the slides, the $20,000. But in reality, if we have to be precise, we have to use the present value that we calculate from our formula. Now, what you just for the sake of the exercise, I want to show you something. If we go here, and what if market interest is not 6.27? What if the market is 6%? If the market is 6% exactly, what that means is our present value will be exactly the amount that we have to pay after 10 years. So for that reason, as you can see, if the market rate is equal to the interest that we're paying on the bonds, or per payment is 3%, which is 30,000, then there will be no difference between the present value of the bonds today and the future value that we have to pay after 10 years. But if the market rates start going up, we have to give a discount because the present value starts getting lower. If the market rate is below the interest rate that we're paying, let's say 5%, we start generating premium. Make sense? I'm going to leave it 6.5 to be discount, another discount here. But you can easily play with, once I send you the Excel spreadsheet, you can easily play with this amount here in the blue cell. And you can see what's going to happen if the market rate goes up above the interest that we're paying, and what's going to happen if the market rate goes down below the interest that we pay. Now let's see the other scenario on the slides, which will be for the premium. Now this is the scenario for the premium. I'm going to copy this scenario and I'm going to post it in the Excel spreadsheet again. And I'm going to grab this one, the premium calculation. I'm going to flip it here. We're going to delete this one. We don't need this one. And the new information is right here. As you can see here, we have issue bonds. So again, $1 million, 6%, 10 years, 2 payments, 10 years, 20 payments in total. Now the market rate in this case is 5.5%. Or per payment is 2.75. What that means is we're gonna have to give them a, actually not we have to give, we're gonna receive a premium. And in this case, if it's 103.81, that means if we have to follow at price at 103.81, what that means is simply the value will be equal to this one time this number here, which number here will be 103.81. Sorry, that will be percentage in order to make it work. That should be percentage amount. So it's going to be 103.81. So for our calculation here for the journal entry, we're going to use this number. And that will be the journal entry that we have to do. For the slides, let's go to the slides. and check the slides, what they doing on the slides. With that case, when we do the calculation, we're going to get the number that we get on the Excel with calculation, but we're going to use $1,038,100 for the rounding, and 38,100 will become our premium. And we're going to have those two accounts, bonds payable with the credit and premium on the bonds payable 38. When we combine together on the balance sheet, we're always going to show the compound amount between the bonds payable and premium, and that will be carry amount of the bond payable. When we issue the discount, the carry amount of the bond payable will be the bond payable less the discount. Now, what's going to happen with this premium and discount? We have to amortize those one over the life of the bonds. Now, there are two ways to do the amortization. One way is to do the straight line amortization. And since we have here on the discount, we have 20,000 discount over 10 years, every year we're going to amortize 2,000. On the other scenario, we have 38,100 over 10 years. Every year we're going to amortize $3,810. That's if you're using the straight line method. Now, we're not going to use the straight line method. For that reason, I'm not going to explain the straight line method. Straight line method is used only and only for the accounting standard for the private enterprises, and it's very straightforward. So for that reason, I'm not going to test you on the straight line method, but I'm going to test you on the effective interest amortization method. Now, what's the difference? The difference is on the effective interest method, we're using the actual interest rate percentage to calculate the interest expense. And that gives us idea how much is going to be the interest payment. Since we have the payment for the interest, which is cash, that's not going to change. Interest expense will be different amount, and the difference is going to be the amount that we have to amortize as a premium or a discount. Now let's see the straight line method again. I told you I'm not going to test you on this one. So basically the slides 25, 26, 27, 28, you can just see it as for your information, but that's not going to be tested. I'm going to test you on the effective interest method. Effective each interest expense amount is the same as percentage of the bonds book, the value interest. The effective interest method better matches the interest expense to the revenue earned. International financial reporting standards require to use the effective interest method. Accounting standards for the private enterprises allow both methods, straight line or effective. That's why the straight line method is shown here, because this, again, the whole this course is under accounting standard for the private enterprises. And as you can see, the course is basically for next year. So that's a very current edition of the book, textbook, and everything. So effective interest rate, how the effective interest rate is going to work. We have to see first the scenario, and let's get this scenario first, and then I'm going to move to the Excel spreadsheet and going to explain to you on the Excel spreadsheet how exactly it works. Let's stop this one sharing, and let's move to the Excel spreadsheet. And let's go to another discount here. We're going to grab another sheet, this one, and going to move to the next discount. And the next discount, we're going to delete this one, and this is the new scenario now. On January 2nd, we issue 1 million. Five years. Now we're changing the 5 years. Sorry, that's a 5 years here. which we're paying 5% interest. You know what? Let's do this. Let's erase everything and let's start from the beginning so you can see actually the calculation. Future value in our case is $1 million. That's one more zero I need here. $1 million. We're paying 5% on the bonds. The annual interest payment will be, if we have to pay per year, will be 50,000. We're paying twice semi-annually, so 2 payments per year. One on January, so July 2nd. First payment will be on July 2nd. If we issue the bonds on January 2nd, first payment will be July 2nd. Second payment will be on January 02nd. So that means every time we have to pay divided by 2, every time we have to pay $25,000. And that will be our payments. Now, period to maturity in years, those are 5 years bonds. Since we're paying over the years, let's make it universal, over the years, payments of interest over the years, that will be 5. Since we're paying 2 times per year, that total payments will be 10 times we have to pay interest. Market interest rate, as you can see, is 6% annual, which is transfer to 6 divided by 2 interest rate per payment. Now what we have to do, we have to find out what's the present value of the principal of $1 million plus the interest payments, that will be 10 interest payments of $25,000 or $250,000. What's the present value of those two amounts? So the present value, again, we're going to go to the formula. We're going to go financial. We're going to scroll down to the present value. And we're going to start plugging the information. Rate is market rate, 3%. Sorry, I was too fast on the enter. Let's start again. I was thinking to change this one in different colors so we can distinct all the amounts. So let's leave it this way. And I'm going to change this one the same way so we can have consistency through all the calculations. So you're not going to be confused with the calculation later on once you're looking this Excel spreadsheet. Trying to make it more universal so every time when you have a question, you can actually go back to this Excel spreadsheet and do the questions using the Excel spreadsheet. That's the whole idea here. So once we have this, so we can go to the formulas. Again, financial present value, PV. Start pulling a rate is again the market rate. That's our rate. Then we're gonna go to the number of payments of interest over the life of the bonds, which is 10. Single payment is 25,000, which is outflow for us. That means minus. Future value is $1 million, which we have to pay after 5 years, which is outflow for us, which is minus. And the question is how much is the present value of those bonds? And once we click OK, the present value is 957,348.99. So we can easily, I can easily do this here. I can go with round, and I can round this number to the 0 decimal. And that's going to give me exact number of the one that's on the slides. So now I have a discount. Now this discount is great. Now what I have to do is I have to amortize this discount over the life of the bond. How am I going to do this? Every time when I do this is on the date of the issuance of the bonds. Every time on the payment date, I'm going to have the similar to the journal entry that we did when it's par, which will be on July 2nd. I'm going to copy this and I'm going to move it here. We're going to have this journal entry here with slight modification. First, we already know that my cash, the cash that I have to pay, will be $25,000. There's no questions about it. This is the cash that I always have to pay on the every interest payment date. That's never going to change. July 2nd, then next one will be January 2nd. And then that's going to repeat all the time. I can unlock this one so I don't have to change it all the time, you know. So I know my cash payments and then they're never going to change. If I have to pull it, this one, it's going to keep going. The question is, how much is my interest expense? Now, the interest expense will be calculated based on the balance on the money that I borrow time the market interest rate. For that reason, we're going to make one schedule here, which schedule is going to have number of the periods. And we're going to start with 0 is the time that we borrow the money. And then we're going to have 1, 2, and keep going. We need here 10 periods since we have 10 payments, 10 periods. Next one will be we can go with the balance. I'm trying to improvise here. So you can see that you can create this chart by yourself. Next time, or next one will be the payment. Next one will be the interest expense. Then next one will be difference. Next one will be the accumulation of the difference. Or that will be difference, that will be the discount. Since we know that there will be the discount on the bonds. And the last one will be again, the balance. Or in this case will be the bonds payable. Okay, let's keep it this way. So now we have all the columns. So on the year, on the very 0 period, what we did, we have a bonds payable, which bonds payable equal to this amount. And we have a discount, which equal to this amount. One thing that I want you to notice is those two amounts, if we have to get the calculation between those two amounts, the total always and always gonna be what's the total value of the bonds. That will be our check. And every time when you calculate the discount plus the bonds payable has to be equal to the bonds that we have to pay at the end of the period or at the maturity. Now, the payments. Do we know in the very beginning how much we have to pay? Every single period. Yes, we do. We have every single period we have to pay 25,000. Is that going to change over the life of the bonds? No. So for that reason, I can easily plug this column with the 25,000, and that will be exactly the same amount over and over and over again. So I can easily log this cell and go all the way down. Because I know at the end, at total, I have to pay $250,000 over the 10 times when I pay the 25. Then the next thing that I know for sure is interest rate. An interest rate is the interest on the market, which is 3% for every payment that I make. So my balance at the beginning of the period will be the same balance on the bonds payable at the end of the period. Sorry, not that one. I have to go one back. So this balance always and always gonna be this amount. The interest expense will be calculated on the balance outstanding time the market rate, or that will be my interest expense. And that interest expense, it's gonna go, sorry again, that interest expense is gonna be flow directly to my journal entry. And that will be my interest expense. So if you want, what you can do is you can put a round formula here to eliminate the zeros. Let's see if this is gonna work. Oops, it didn't work. So round, let's do this. And that, let's see if this is gonna work. No.
Professor, your spelling.
Oh, round. Yes, my spelling. There we go. Now is a different story, right? Once we do that interest expense, then we're gonna see the difference. The difference between is gonna be in this column minus the payment. That will be the difference, 3,720, and that will be my amortization of a discount, which is gonna start reducing my discount amount. And the same amount is gonna go to the increase in the bonds payable. And on my check, I have to get 1 million. Because I perfectly know that at year 10, my bonds payable, the bond that I have to pay, is exactly $1 million. What that means is that once I amortize the discount, this discount should be equal to 0. Make sense? That's my objective. So now, what I'm gonna do is, I'm gonna start plugging those numbers. Since I have this one here, I can easily drag this number down. This one is already calculated 3%. I can drag it down. Now this one is gonna be around, why it doesn't calculate it? 19 times. Oh yes, because I didn't log the percentage here. Let's log this percentage. And now when I drag it down, it's gonna show me the percentage. The difference, I can drag this formula down. The discount, I can drag it down. And the last one will be the bonds payable, I can drag it down. And as you can see, at the end, we should get what we want to get. Now, because of the rounding, obviously, we have this difference, but if we eliminate the rounding, let's see what's going to happen if we eliminate the rounding. Is that going to solve our problem with the $2 that we have remaining? And if I drag this down, I'm going to end up with 2 cents difference. And this is your schedule. This is how you prepare the schedule for the amortization on the bonds when they have a discount. So from this schedule, you can start plugging the journal entries. Again, interest expense, it will be, you come from this form, from this cell here. The cash is going to be 25,000 because that's the payment. And now we have to put the journal entry to balance the entry, which will be our discount. I can easily copy discount on bonds payable. And we're going to start reducing this discount until we bring it down to 0, which will be equal to this amount. And now we're in balance. On January 2nd, which is the second payment, our interest expense will be next one, that much. Cash will be 25. Now sorry, this one shouldn't be here. This one should be right here in this cell. then the discount is gonna get that amount. What we can see from this table is since the balance, as you can see, the balance of the bonds payable start increasing, the interest expense start increasing. Means the difference start increasing, or that will be our the discount that we have to amortize. And that's how we're gonna reduce the discount on the bonds payable down to zero until we bring the balance on the bonds payable, because at the end of the period, remember, we have to pay $1 million. This will be for the discount. And from here, we can get the general entry for the third payment, for the fourth payment, and all the way to the end. Now let's see what's gonna happen if, do you guys have, gonna give me 5 minutes to explain to you the premium? Okay.
Yes.
So let's see what's gonna happen if we have to create the same thing and we have a premium. I'm gonna go quickly to the slides and I'm gonna put the slides with the premium. Market rate on the premium is 4%. Okay, I got it. Okay, the premium is, this is the calculation for the premium, and let's flip it here. Move it one more. This. So the premium here, let's delete this one. That doesn't make sense. Put it this way. So assume the company again issue $1 million, 5%, 5% here bonds. So if I have to delete everything, and let's go with the 1 million, 5% interest payment. Annual interest will be 1 million times 5%, or 50,000 per year. We have 2 payments per year. That will give us 25,000 per payment. Then we're gonna have maturity will be 5 years. And since we're paying the interest 2 times per year, total payments that we have to make on those interest payments will be 10. Interest rate on the market is 4%, which gonna drive us our premium since we're paying more than the market. And then the market rate interest per payment is gonna be 4% divided by number of the payments that we're making per year, which is 2. So the 2% will be our market rate that we have to use in our formula. Now we're going to the formulas and we're gonna get the financial again, present value. And the present value will be the rate, which is the 2% the market rate per payment. Number of the payment over the life of the bond for the interest is 10. Payments for the single payment amount is 25,000, and since this outflow for us is negative, future value will be 1 million, and since we have to pay, that will be negative outflow, and we come up with the present value of the bonds today. As you can see, we're exactly matching the numbers that they give us on the slides. So that will be the cash that we're gonna receive. Our cash is gonna be that much. So our premium in this case is 44,912.93 on the day of the issuance of the bonds. Now we have to start preparing our schedule for the payments. I'm gonna grab this one. There will be slight modification, and which I'm gonna show you in a second. But I want to use this template so you can see it. The cash will be that much. We have to insert one amount here, and get rid of this one. And then I can do exactly the same. Okay, now we have to start working on our schedule to amortize this premium and bring it down to 0. And this balance the cash that we get on the bonds to go down to 1 million. How are we going to do this? The same thing. First one will be the periods. And that will be the number of the periods. Again, we're going to start with 0, 1, and 2, and all the way down to 10, since we have 10 payments. Then we're going to have a balance. Which balance we're going to see later how much exactly is. Then we're going to have the payments of interest payment, which is always going to be the same. Starting from the first period will be 25,000, and that's not going to change until the last payment that we have to make. That would be the F4, and it's going to go all the way 25, 25, 25. Next thing that we have to calculate will be the interest expense. Let's push it down a little bit. Interest expense. And for the interest expense, we need the percentage. And the percentage is the market, 2%. Then we're going to have our difference here. Difference will be the interest expense minus the payment. We're going to see how much is it. Then we're going to have the premium. And the last one will be the bonds payable. Bow balance. And we can put here one column, which will be our check. So premium, we already calculated on the time of when we issued the bonds, our premium was 912.93. And that brings the bonds payable to this amount. So now our check here is, compared to the discount, our check will be, this amount will be equal to bonds payable minus the premium. Not plus, minus, since we're on the premium. So what objective is to bring the premium down to 0, reduce the bonds payable down to 1 million, because that's how much we have to pay at the year 5. That's too many zeros here, one more, less 0. So let's start doing the calculation. Balance, obviously, will be this balance here. 25 is 25 payment, that's not going to change. Now we have to calculate the interest expense, which will be based on the balance times the 2%, which is the market rate. Let's lock this one, and I'm going to give it this amount. As you can see, compared to the previous scenario with the discount, our interest expense is less than the payment. So the difference here will be the payment minus the interest expense. Now that difference is going to start reducing the premium to bring it down to 0 and reducing the bonds payable balance to bring it down to 0 to $1 million as well. And now I can drag all the formulas here and let's see what's going to happen. Are we going to achieve our objective? This one to become 0 and this one to become 1 million. Once we run everything, everything works. Just like magic, everything works. So we did a good job on this calculation. So from here, I can start plugging my entries. My interest expense will be this amount. That will be equal to this amount in this case. My cash will be 25. And now I need debit. So my debit here is going to go to reduction of the bonds payable, premium on the bonds payable, but on debit side. Since I create the bonds payable premium on the credit side, on the debit side, it's going to start reducing it until I bring it down to 0. How much I'm going to reduce the first period? 4,101.74. Next period, I just have to do exactly the same. Get the interest expense. And that will be my premium here. And the premium is going to be equal to that amount. And those two are going to give me 25, and I'm in balance. And keep going and keep going, keep going until the end, and bring it down to bond payable to 1 million, which we have to pay at the year 5. Premium now, there's no premium. And we calculate the interest expense and expense the interest expense. As you can see here, when you do the observation, since the balance of the bonds payable going down, our interest expense also going down compared to the discount when the interest expense going up. Here, the interest expense going down. That was everything that I wanted to show you today. Now, next time we're gonna come back to this with the discount and premium, because I want you to get very comfortable with the discount and premium and using the Excel spreadsheet and calculation for the discount and premium. Because technically it's very logical, but in the beginning it's it might be trickier. Question, guys? Any questions?
All good, thank you.
All good?
Yes, well, I need to practice a bit, but so far I think I'm good.
So what I'm gonna post you the recording. I'm gonna do the recording today. I'm not gonna forget to do it at the very last moment. I'm gonna once the recording is completed and done in the Zoom, I'm gonna post you the recording. I'm gonna send you this Excel spreadsheet. Okay, we're gonna organize it discount, 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 and premium, premium, premium. Let's move it this one to be premium, premium, premium. And you're gonna have it everything for you available. So once you see the question with the bonds, what I want you to do is to think about it. How much is let me start here because. So once you do the question for the bonds, what I want you to do in the very beginning is to take a look at the data and think about it. How much interest I'm paying and where the market is. If the market is above than what you're paying as interest, that brings you to the scenario with the discount. If the market is below of what you're paying as interest, then you can charge the premium. And that brings you to the scenario with the premium. That's why it's very important for you when you're reading the question to realize this. Where am I? Where the market is. If the market is high, discount. If the market is low, premium. That's what I want you to remember when you're doing bonds. And that's where we're going to end up today. Thank you for your time. I'm sorry that I keep you a little bit longer, but I wanted to finish this premium discounts and the amortization schedule for premium and discounts. And next time we're going to go back and going to repeat all those things.
Thank you.
Thank you, bro.
Thank you, guys.
Thank you,
Enjoy the rest of
Professor.
your day. Have a wonderful Sunday, and we're going to
Thank you,
hear each
Prof.
other next Saturday.
Thank you, bro.
Thank you, guys.
Professor.
Thank you. Thank you.
Oh, Prof, I have a question.
Yes.
In Pearson, I was doing my assignment last night at 8 p.m. But the time
Okay.
on Pearson, it's 12 a.m. already. I'm not sure if that's already.
Oh, okay. Okay. So I see what's happening. No problem. I'm going to change it. It's for the set. Probably it stays on the Toronto time, not the Pacific time. I'm going to go to the course and I'm going to change the time.
My
Just give me a
my
course
assignment
set.
was submitted though, but I'm not sure if it counts or not.
Let me see. Let me see. Yeah, Easter time. It's not Western time. I'm gonna change this one right away. That's easy fix. Thanks for letting me know, though.
Yeah,
Thanks for
bro.
letting me know.
I was worried that I might
Yeah.
be late to the deadline.
No, don't worry about the assignments because once you tell me this, I can easily go and fix it, and I can give you the extension. That's no problem at all.
Thank you so much, bro. Have a good day.
You too. Thank you. Thank you. Any other questions, guys?